Welcome to Trader Hub and Yellow Tunnel and TradeSpoon. We have simultaneous broadcasts. On Thursday, I talk about market conditions and any questions you might have about from Trader Hub, or if you have questions on TradeSpoon Yellow site, so please post your questions. I'm going to go through the current market conditions and some of the trades that I did this week. And eBay is one of them, Netflix is the other one, and then go through earnings strategies and opportunities going forward. So welcome everybody. I'm glad you guys are able to join. Fred, Bob, sound is different. Yes, we have Trader background sound, so hopefully that makes it a little bit more exciting. For those of you who are new, welcome. This is my bio. I think Yellow Tunnel is a little bit different from other podcasts. Is that my background is technology. I have a master's degree in computer science. I was a CTO of several publicly traded company. Always been in fintech space, and for the past over 10 years, I've been building models and neural networks. And I have a team of financial engineers that are finding trends in the market and finds which stocks or which sectors can outperform the market. And with the latest advances in AI, we're actually able to, the new AI is actually be able to learn on its own which stocks belongs to which clusters and which clusters can outperform the market, and can backtest, learn on the data, make inferences, and make predictions. So I'm pretty excited about that. And I use these models to actually manage my own money and trading. So that's the difference, that not only do we build signals and build models, but we actually trade them every day. So that's my background. Disclosures are very important, since I'm going to go through specific trade ideas and actually positions that I have live. It's important to look at the disclosures. Trading stock and options involves risk not suitable for everyone. Oh, Cecile, welcome back. I'm not a financial advisor. I'm not registered with FINRA nor SEC. If you're new to options, I encourage you to visit optionsclearing.com so you can understand the risk associated with trading stock or options. All right, before we jump into trading psychology, right? I mean, from trading psychology point of view, it's very important to have a trading plan, right? I would encourage everybody to keep a journal. In your journal, I would write down all the trades that you make and grade yourself, right? The most important part of the trading plan is risk management. So if you're part of Yellow Tunnel, you would, and TradeSpoon, you would see that I propose to have no more than 4 positions, and not to risk more than 2.5% of your account value per trade, right? If you're doing day trading, less than 1%. If you're doing holding position overnight, then no more than 2.5%. So that's in the journal, where when you document your trades, have a checklist. Do I have more than 4 positions? Yes or no? Am I risking more than $250? Yes or no, right? And there are different rules that we cover in live trading room, bid and ask spread. Maybe you don't want to trade meme stocks, and so on and so forth. So let's look at the current market condition, what to expect, right? Not much has changed since the morning when we had the live trading room. But it is a closing bell, yes. So we're going to do a closing bell. I'm going to just do a little bit more on the market conditions, but we jump into live trading room as well. So looking at the spiders, not much has changed since this morning. We are basically retesting this important support level, 503, right? So if you look at the model, basically the model predicted that spiders is at 505 support and overhead resistance is at 510. If you zoom out next 10 days to 30 days, next level, if we break through all-time high, which is 510, then 517, 520 is your overhead resistance. On the downside, 480 is your support, right? So I agree with the model. This is a neural network, right, that runs every day and makes predictions for spiders and for other stocks. So 517 is your overhead resistance. Support is 480. I agree with the model. I think 480 is well positioned. This is actually below 50-day moving average. It's probably aggressive, but that's the breakout, right? This is a breakout from multi-year overhead resistance, right? Going back to 2022. So that's long-term support. Medium-term support, I think, is well positioned around 50-day moving average 490. We're going to look at the positioning, dealer positioning shortly. So that's your medium-term support, and short-term support is the gap, right? Is the gap and this uptrend line. So you have support number 1, support number 2, support number 3. What can derail the market? Interest rates, right? Earnings season is behind us. NVIDIA announced earnings. Most of the stocks have positive surprise. You can see a lot of enthusiasm in call buying on a lot of the high beta stocks. Beyond Meat is a perfect example this week, where it was up over 100% overnight. So interest rates can pull back, derail the market rally. We have unemployment data next Friday, and then we have CPI and PPI data. But as long as we're staying above this uptrend and support number 1, it's pattern of higher highs and higher lows. Model sees 520s overhead resistance. If we break support number 1, then it's support number 2, support number 3. So depending what kind of, this is a long-term, right? This is a medium-term support, and this is a short-term support. So based on type of trader you are, doesn't matter if you using support number 1, support number 2, support 3. The point is that you don't want to risk more than $250 on $10,000 portfolio at any of these levels. So if you selected 505 and you're doing day trading, and let's say you put, to make it easier to calculate, 5 points as your stop level, right? Or you're using 490 as your stop level, which would be maybe 20 points, right? You just take 250 divided by your stop loss, right? And let's say 50 shares here, or 24 shares here, right? So and I would write it in a journal and grade myself, right? If I'm doing short-term trading, support number 1, and my position never was down more than $250, I would put A or B. If it's more than $50, then I would put C or D, right, to grade myself. And you always want to have A's and B's. All right, so let's go over some of the trades this week, right? So I do like to do earnings power trader. So if you look at the earnings power trader, this week, model basically, we're looking at the implied volatility versus historical volatility on eBay. And in this example, I'm selling premium, selling iron condor. Why am I selling iron condor? Because of the positioning. So if you look at the positioning, borrowing this screen from our friends at Trader Hub, using their platform, this screen shows you dealer exposure, right? And the most important thing to realize is that you have different strike prices, right? You can see at 48 level, right? 48 level, you have large interest, right? Large open interest in relative terms. And then you also have at 50, right? So these are out of the money puts and out of the money calls before the earnings announcement, right? The screenshot is February 27. On the downside, you're well protected at 42 level, right? So it's basically distribution of outcomes. On one hand, eBay can drop 5% and reach 42, where people are buying puts, and bears supply and demand will meet. And depending on the earnings, most of the time, even if it's negative surprise, it will hold. The other possibility, you guide higher, you beat on the bottom line and the top line, and you're trading at 48. So usually I like to sell, when you have a put skew in this example, where puts and calls are well positioned, the best thing is, one of the strategies that I utilize is iron condors by selling out of the money premium, right? So in this example, I sold 50 call because it was outside of that 48 strike, right? And I sold 39.5 because it's outside of the 42. Right? Able to collect 13 cents plus 11 cents, 24 cents. So 24 cents, about 0.5%. So I'm looking for 0.5% to 1% premium. And these are short-term trades, right? I'm trading weekly options, iron condors, with the idea that it will not break through this level, right? 39.5 and 50. And one of the reasoning, I see that, before you get to 50, right, there's not a lot of support and demand at 50. But at 50, it should hold because this is where the dealers have to sell, buy calls for everybody who wants to sell calls, and also at 49. So now if you zoom forward and actually see what happened after the earnings, right? We're actually positive surprise right after the earnings. It hit 48 level, right? And after that, it kind of gravitates toward this 48 level for the past 2 to 3 sessions. So is this a coincidence, right, that it's at 48 strike, or is the better explanation is that before announcement, this is where you had a large open interest, and even up until now, the stock is still trading at the level where there is a very high open interest. Again, this is a probability of distribution of outcomes. It doesn't have to be this way every time the stock trades, but obviously this is very helpful information to determine with a positive or negative surprise where the bulls and bears will meet and where the support and resistance, right? In trading, most important is sense of direction and support and resistance level. So between the neural networks and the dealer exposure, you can determine ahead of time where the support and resistance levels are, and based on that, you can make, the right determination. Also, in the aggressive power trader, another trade was this is earnings power trade. Aggressive power trader is purely neural networks. Finding the models, this is where I trade stocks. So I did trade NVIDIA today, and I traded Netflix. So let's go over Netflix. So Netflix was yesterday, right? Yesterday, Netflix, again, model determined that Netflix should continue to outperform the market. The market opened, right, on February 28th, which is yesterday. Let's type in Netflix. And see what actually happened. And I encourage you to type in any questions you guys have, whether it's a Trader Hub or on the GoToWebinar. So let's do 15-minute chart. Right. So yesterday in the live trading room, some of you guys were there. Give me a second while Netflix is loading. I'm gonna restart my browser. Okay, so February 28th, market opened right away. The model did basically found a support and resistance level at near 590, 592 level. So I did say, first you want to wait 15 minutes to see if market can find a support, right? And then once it starts going back up, this is where you would enter the trade, right? So I think I entered it at 9:42 Chicago time. So yeah, 9:42. 9:42 Chicago time, when it starts going back up, and you can see it, rallied 0.5%. I exit the position. I mean, if you waited till, if you want to keep the position overnight, you would have made maybe 1%. But that's the setup, and these are the type of trades we do in aggressive power trade, right? Short-term trade. If you want to hold this overnight or for a few more days, you can do that, but then you have to manage the trade, right? And support and resistance. If it's a short-term trade, maybe you're looking for 0.5% to 1%. If you're holding a week, maybe you're looking for 1% to 2%. The other trade was Netflix, NVIDIA today. Same kind of idea, a little bit different. The stock actually rallied in the morning, right? But I did decide to close kind of just for a small loss because it did break through the support, right? It rallied. Big open, not big, but there's a gap in the morning because of better than expected PCE data. So I decided to enter the stock, but it did break down and almost close the gap at 783. So when it recovered to 792, I decided, since since the session low that usually acts as a support is broken, I'd rather break even, right? Take a small loss and then move on to the next trade, right? Because every day there are signals, and if you're a short-term trader, you don't want to take the risk. Obviously, if you want to hold the position longer because you think NVIDIA is a great stock and will continue to rally, then you can do that as well. So that's an example of earnings, right, where I sell the premium based on positioning, based on the neural networks. This is short-term trading, an example of NVIDIA. So let's go over other examples for earnings, right? So today, in terms of positioning, you have Autodesk, NTAP, Zscaler, Fubo, and Plug. Plug, Fubo, these are few dollar stocks. They can move 50 to 100%, similar to Beyond Meat, right? Very large short interest. A lot of people think that these companies will not survive. So it can go to zero. It can go to to 6 or 100% up, 100% down. So I personally don't recommend these type of trades unless you like volatility and you part of the blogs where you only live once and you buying out of the money calls, which is totally fine strategy, or buying out of the money puts. I also sometimes do that. But as long as you realize that probability of success is relatively small, right? But even if you 1 out of 10 trades or 2 out of 10 trades, like Beyond Meat, where you buy out of the money call and stocks go up 100%, you just need 1 successful trade, and it will cover 9 unsuccessful trades. But it's just different type of trading. Zscaler, again, on a $10,000 portfolio, if you're doing 1 contract, that's $24,000, right? And on a $10,000 portfolio, probably the strike price is probably not appropriate to do the selling the premium, especially after P&W earnings, right? We've also traded P&W earnings, and they guided lower. They might not be identical companies. They're both in cybersecurity, but one is more of an old school, one is more AI. I mean, that's I think I don't usually dwell into a balance sheet and business models, but they are slightly different. But you can see P&W guided lower, and you had this extreme move to the downside, right? So Zscaler, it could follow P&W, where if they guide lower, I think you will have a large move to the downside. Or if they guide up and, the worst fears are over, then it would rally 20%. So because average account is $10,000, I don't think it makes sense to take a risk on the stocks that can move 20 to 30%. So that Autodesk similar, 258 strike price, stock price. That means if you trade in 1 contract, you multiply it by 100, that's $25,000. Probably also inappropriate, right? Why is it inappropriate? Because if you're off, let's say 1 or 2%, well, $258 stock, if you let's say sell put premium or call premium, and it moves 1 or 2% beyond what you think will happen, well, 2% of 258, that's $500, a little bit more than $500. Well, then you're breaking your rule right away. Even before you get into the trade, you know already you're breaking the rules. So that's why having a checklist is extremely important, so you don't break these rules. NTAP is $89 stock. It doesn't really move 20, 30%. It can move 10 to 15%. So let's look at the positioning on NTAP and see what people think, what historical volatility is versus implied volatility, and how people are positioning into NTAP earnings today. So, 10 to 15%, right? We can look at, first I would look at implied volatility. Let's visit our friends at Tradier. So you want to look at implied volatility, because options is basically a voting machine for what people think is going to happen. right? So you want to take advantage of that. So based on these votes on weekly options and probability of distribution of outcomes, you look, I mean, there's different calculations for implied volatility move. I like this because it's easy. I can do it in my head very quickly. So you add the straddle, right? You add the straddle, at the money straddle, and you add out of the money strangle, right? Puts and calls. One you buy in long, one you sell in short. So roughly 340 plus 310 is 650. 650 plus 250 is $9 plus $3, $12. So implied volatility basically says 2 standard deviation, it's going to move $12. 1 standard deviation, it will move half of that. Usually you do, so $6. So roughly 60 to 70% chance that it will move $6, which is what? On $90 stock is about, call it 8%. 2 standard deviation would be $12. Historically, if you look at NTAP, in the past few quarters, it's been volatile, right? Last time, so last time, it moved 15%, right? It moved 15%. I mean, initially it moved 10 and then all the way to 15%. So it could move basically to, it just did last earnings. It could move to standard deviation this earnings as well, right? So that's the calculation. Sorry, I think the screen was paused for a second. But that's the calculation, right? At the money straddle, you add out of the money strangle, and you divide it by 2. That would be implied move. If you want 2 standard deviation, kind of look at what's the 10% probability. Well, there's a 10% probability it will move $12, basically. Last time it moved 15%. So, okay, now let's look at how people are positioned, right, in terms of NTAP. So a lot of, let's see, auto range, domain range access. Okay. So there is a very large, relatively, but I would say very large interest in 1 of 5, right? Kind of, it's not negative VANA, right? So you still have a puts. I mean, you don't have a put skew. There's obviously a lot of demand for calls. Basic demand for puts. Nobody is buying puts going into earnings on NTAP, right? And I kind of alluded to the sorry. Snowflake. Right, Snowflake was actually worse, right? Snowflake, people instead of buying puts and protecting themselves on Snowflake, they were shorting, right? They were shorting the puts in weeklies that expires this week, right? You have relative large negative VANA, and someone was hedging this short position, but out of the money. Buying out of the money puts that expires on monthly expiration, right, in March. And you can see today, Snowflake had a negative surprise, right? This is data analytics firm. It used to be one of the hottest IPO. They guided down, right, similar to P&W. They beat on the bottom line, beat on the top line, but they say, listen, next year, maybe not such a great earnings. And you can see stock is, dropped 22%. And incidentally, it's actually trading at between 180 and 189, right? So kind of another good example, why are we trading between 180 and 90? Well, that's where people were positioned, right? This is where some people were selling short puts, and this is where some people were buying puts. And it's not at 160, it's not at 200, it's magically at 180, 190, right? So that's important information, that these strike prices with high open interest, they do act as magnets or repellent, right? Depending on, usually if it's puts skew, it acts as a magnet, and if it's a call skew, like in this example, it could actually act as a repellent. Okay. So NTAP. NTAP, basically there's no put buying. So any surprise, any announcement that they missed on the top line, missed on the bottom line, and there's really no barriers. There's really no place where it would stop. So from that reason, again, and if you want to sell, let's say, get 20 basis points, 80 put right now is trading at 30 cents, right? So it's not even half the premium. And if you sell 80 put, right, or even 75 put, right, you're collecting very little premium, but the stock can move 10 to 15%, right? $90, take 10%, that's 80. And the reason you don't want to sell premium, at least I don't think you should sell put spread in this example, because just nobody thinks that NTAP can go lower, right? And when nobody thinks that NTAP can go lower, it opens the window for negative surprise, and then the stock will drop. So for that reason, I think I will take the contrarian point of view. Instead of going short the volatility, right, I'm going to be long the volatility to the downside, right? So I propose to do maybe 80-78 put spread. That's what I did in my account. So I'll do it here, trade option. And tap. So one standard deviation would set 6 points. So probably maybe even go to 82, 83 level. Let me see. So 83.75, 85 cents, and 81 put. So I can put this trade for 40 cents in March. The problem is that it expires tomorrow, so it can move half the distance. Or I can go into the next week, since next week also nobody's buying puts, and I can buy, let's say, 83, 81 put for 50 cents or 6 cents. Yeah, let's go to the next week. So instead of this week, I'll do 82, right? That's one standard deviation move. Buy 82 put that expires next week. Give myself a little bit more time to be correct. Basically, if positive surprise, well, then they'll expire worthless, right? But even if there's negative surprise, even if it's not moving 2 standard deviation, let's say it moves, 1 standard deviation, then I have another week along with unemployment data to see if it goes in my direction. So let's see, did I have NTAP here? Oh, I did not put NTAP. Okay. So you'll find it in the TradeSpoon Elite Circle. So I'm buying 82 put that expires next Friday for 93 cents. So I'm spending 1%. NTAP has to move at least, half that distance for this trade to be successful. But 80 put would be, again, almost 2 standard deviations. So most likely it's, and let's look at the positioning. I mean, there's some 85 put. I mean, there's no really position anywhere. March 15. Let's see. Is there April? Yeah. So there's really no positioning. So not to spend 1%, right? If I don't want to spend 1% of the premium, then I can basically sell 80 put. Let's see, maybe even do calendar spread. Let's see, 80 put or 30 cents. Maybe do 81. Yeah, let's do 80 put that expires this week. It's maybe 20 cents difference. But that will allow me to sell it twice, basically. So we'll do diagonal. Okay, so if I want to reduce my cost basis, right, and spend, maybe, 60 cents, then I would sell 80 put, right? So in case the stock doesn't go anywhere or goes up, well, then I lost 60 cents, right? So I know my maximum loss is 63 cents. If the stock moves, let's say, not one standard deviation, but even, half of the standard deviation, right? Let's say it moves down 5%, right? Well, then 80 put will expire worthless. 82 put will most likely still have majority of its value intact because it expires next Friday. And then I can go in and sell 80 put that expires next Friday, or I can sell, or I can close the whole position, right? Depending on where it's, ends up. If it stops at 80, ideally you want it to move to 80, right? So it would move basically, the best case scenario, the most profit I can make, if it actually moves to this 80 strike, right? It's down 10%. If it's down 10%, then, the spread will cost a little bit more than $2. And, I risked 60 cents and I made, $1.40. $60, $1.40. Yes. So double my money. So that would be the setup. If I wanted to finance this trade, I can sell out of the money calls, right? You do see a lot of positioning at 105, right? There's a much bigger demand for calls than the puts because everybody thinks the opposite. Everybody thinks that the stock is going to do great based on the last earnings. So let's say 2 standard deviation would be 90 plus 10, let's say 100. So there's a large demand at 100 level. So I can sell 45 cents. I mean, it's about 0.5%. But again, that's 1 standard deviation. Stock could have a positive surprise, right? AI, you need data centers, you need storage, right? Kind of NVIDIA type of earnings. Then, it can move 15%. Well, 15% of the stock that's trading at $88, right? That's 103, 105, right? 103, 105. So 103, 105, I can only get 25 cents, right? So only 20 basis points. So almost it doesn't make sense. It doesn't make sense to sell the premium. And it's probably not going to get much further than 103, 105 because you have a lot of people selling calls. So my inclination, just since not enough premium for 2 standard deviation move, and there is a lot of selling of the calls that will act as a buffer, you could do a call spread too, right? You can say, well, you have no idea. You can buy a call spread, right? And kind of do a straddle. As long as it moves up 10% or down 10%, you can make money. So that would be an alternative, right? If you want to risk more than $60, if you want to risk $120, you basically say, well, it went up 15% last time. Why can't it go up 15% again, especially when majority of the people think that it will get to 105, right? Everybody's positioning to either, there's some level of buying at 89 and then a lot more at 105. So you could buy, let's say 90, right? Stock is trading at 89. Well, not 90, 90 is Sorry, that's too close. So here, 100. So you can buy 100 call, right, for 55 cents. And let's say you want to sell for 30 cents. You can spend another 20 cents. Maybe it actually makes sense now that I think about it, that it can get to 100 level. It's actually pretty cheap. Consider there's a lot of open interest there. Okay, so maybe let's do that. Let's spend another $20. So trade option and tap. Here I'll just do vertical. 88, 100, so 50. 50 cents. $0.55. So 100 call, I'll buy 55 cents. I don't want to risk 55 cents. All right, so think of it as a straddle, right? I'm buying put spread and buying call spread. It's just in puts, it's the diagonal, and in call spreads, it's vertical. So I bought 155 cents. It's, chances that it'll get to 100 is only 67%, right? So chances that it's going to get to 102 is even smaller. So I'm going to sell the 102 call for, let's see if I can get 35 cents. Maybe not. 30 cents. Okay. So that would be the NTAP trade for tomorrow. So if it does nothing and it stays at the same level, no positive, no negative surprise, right? Very few companies nowadays actually stay flat. Well, HPQ today, but NTAP, it could be. Then I would be down 20 cents on the call spread, and I would be down 60 cents on the put spread. So I would lose 80 cents, right? So the stock has to move basically either up or down more than 80 cents, right? So it has to get close to 102. If it gets to 102, then I made $1.20. If it got to 82 strike, then potentially I made close to $2, right? And risking 80, so $1.40. So if it actually gets to the 80 level, then potentially it could be more, right? Because 82 put will not expire will not be $2, it'll be $2 plus some time premium. So that would be a setup for, and this is where you make a decision. Do you want to sell volatility or do you want to buy volatility? In theory, like in a situation like this where nobody's hedging, you probably should be concerned selling volatility when there is no open interest, because you just don't know what kind of earnings will be. Here, that there is a lot of call selling at 100, 105 level. So more likely than not, the stock will not get much further than 105, right? And then the question is, do you want to sell 105 call? After last earnings, sell 105 call, receive 12, 15 cents. Personally, it's just not enough premium to justify the risk. Any questions on NTAP, eBay earnings, very similar setup, or Netflix, NVIDIA? Lalit, is Dell a good earnings candidate? Let me see. Have I traded? Have a spreadsheet of all my trades. I think I traded it last time. I think it was pretty volatile, so I decided not to do it. So it can move up to 15%. I mean, here in September, I think it moved. You kind of ride this wave of AI. So it could move up to 15 to 20%, right? That's the last the 2 earnings ago. Let's look at the volume. I mean, you want something that trades in pennies, ideally, right? And has high liquidity. 6 million shares, that's pretty good, okay? Can move up to 15%. Then I would look at the implied volatility move. Let's do our quick napkin calculation. So $4.20, so straddle, $4.20 plus $4.30, that's $4.50. Out of the money strangle is 8, right? So wait, hold on. 8.50, 8.50, 9, 12. 12 plus 4, $16. So $16, right? Because last time it moved 15%, $16. 16%. So about 15 to 16%. 2 standard deviation, implied volatility is half of that, so about $7.50. So a little bit less than 10%. So 8%, 1 standard deviation, 15% would be 2 standard deviation. So $15, you take 94 plus 15, 110. A lot of premium, right? So this is one of those stocks that probably have a large call. Let's see, large call Vena, right? So I bet it looks like Roku, not Roku or a Snowflake. Let's see. Well, there's a lot of call buying and selling of the puts, negative Vena. Okay, so I was right, but not very big, not very large, relatively small. Let's go to March 15. Yeah, so here you have a large, I mean, it's not thousands, but you can see nobody's buying puts, nobody's selling calls. It's kind of, I wouldn't say you only live once kind of type of stock, like it's not Beyond Meat or even, what is it called? Snowflake. But nonetheless, people are buying calls thinking that it actually can go to 120, right? 120. So selling 115 is, when there is such a large open interest at 120, I'm not sure if I want to do that, especially you are riding the wave of artificial intelligence, right? Taiwan Semiconductors did 2 standard deviation move. AMET did 2 standard deviation moves. So the earnings volatility is at its peak, very similar to 21, because there's a lot of retail flows. People are basically, you only live once, so you buy calls and you're gonna, 10 times return. So actually, there is no strikes beyond 120, right? So there's no strikes beyond 120. So selling 120 doesn't make sense, right? Sorry. And we said $15 would be 110. 110 is, you're right in front of this large, not right, but relatively large open interest at 120. So, but even 15%, right? That would be, what did I say? 95 plus 110. How much can you get for 110? 110, you can get 50 cents. But again, you're standing right in front of this large volatility. And it's a pretty wide bid and ask spread. So not my favorite setup, right? Because it's not trading in pennies, right? You have 10 cents bid and ask spread, pretty wide. And you also have, that, maybe not everybody, but some people are buying 120 calls with the idea that it will move $25, dollars. So selling 115 call, I probably wouldn't do it. There's no put buying, right? So let's, I like to do, like, when you don't have enough premium to take the risk, then it makes sense to take a contrarian view, right? And it can move $15 to the upside, it can move $15 to the downside. So how much do I have to pay for $80 strike? 30 cents. So that's not a lot, right? It's not a lot. Less than 0.5%. So if you think you can undo all this, this great, enthusiasm in terms of strike price, right? The 80 put, right? Then maybe it makes sense to risk 30 or 35 cents. I think it does. I'll do it in my personal account. Thank you for letting me know. So Dell. Okay, so I'm putting my spreadsheet and I'll basically buy a put. Expires today, or let's see, March 8th. How much is it for March 8th? 10%, 980. $85 by, let's say, 60 cents. So I'm comparing March 1st to do I want to spend 30 cents on 80 put, or do I want to spend for next week? So 12. All right, probably 80. So 84 put that expires next week is $1.20. Actually, I have to pay $1.25. So same kind of idea. I mean, it might not drop, one standard deviation. So then you would go to the next week. Next week, 85 put, right? It would move basically $9, 10%, right? This 60% of the time, if it moves to the downside, it will get to the strike price. So 84 put is $1.25. $1.25. 84 put. 84 put is $1.25. Pretty wide bid and ask. I don't want to spend $1.25, so I'm going to do a spread. 84. Let's see, 82. $0.40 or even. So actually gonna sell this week 83 put for 55 cents. By 10% would be $9. That would be, so 10% of $9 would be 85. Okay, 85. So 83 is fine. So still did actually, instead of vertical, did diagonal. So I'm buying 84 put for $1.25, and then I'm selling 83 put that expires tomorrow for 55 cents, with the idea that it's not going to get to 83 or not much further than 83, right? That's the 2 standard deviation, $15 move. It would be $11 move. And then, then make a decision, close the spread or roll it or whatnot. So I like Dell. I wouldn't sell premium, but I do like these type of setups where everybody thinks that stock, you can't have any negative news. Well, that means that if you do have negative news, right? Dell had issues before. HPQ actually guided lower, right? I mean, that's not identical companies, but it was down almost 10%. Pre-market after the earnings. So we'll see. HPE, usually I don't trade HPE. 82 put, sorry, Cecil. So I did 84, 83 put on the Dell, right? So Dell, I did 84 put that expires on March 8th, and I did 83 put that expires tomorrow. So diagonal, right? With the idea that this premium will disappear tomorrow, but the premium for the next Fridays, assuming a down move, will disappear a lot less. Obviously, if the stock goes up, then I lost 70 cents. So I'm risking 70 cents. QQQ is at the high of the day. Okay, so let's look at the market. Let me know if you guys have any questions. So 10-year yield did pull back. Dollar stubbornly continues to grind higher. QQQ and Spiders are at session high. Yeah, Spiders almost retesting the highs, kind of following what the model predicted. But there's no new information. 505.69 by 509.80, and we are at the high for today was 509.80, or close to that level. IWM is up, regional banks are up, ARC lagging, gold miners are up, silver is up. So you do have a few sectors that are moving higher. Actually, hold on a second. Let me look at Bitcoin. And Bitcoin is at 62, so it's kind of didn't make new highs today, so we'll see how it trades in the next few days. Nvidia is up. I'll exit Nvidia too early. Okay, so should have listened to the model, right? But it's a good trade. Still a good example of how to manage the position. It actually came to the level that I was trading. All right. Any other questions? All right, guys, that's all I have for today. Thank you very much. I hope to see everybody tomorrow morning at Trader Hub. I hope to see everybody next Thursday, same time, same place. And I appreciate your time. Thank you very much and have a great day.